All right, ladies, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, co-founder of Madison Trading Software, Mike Patton. Good morning, Mike Patton.
Good morning. Good morning, Sip, and good morning, everyone.
Uh, Today is September 14th, episode number 25. And hold on, I'm just hearing myself, so let me mute that. Back in the swing of things, had some big inflation data. Like I was looking at the charts, and it's like every time we have this bad inflation data, we have a huge market sell off, and then like we just rally back as if we forgot that we just had that horrible CPI data. What are your thoughts?
This is exactly right. It's like the first day, everyone's like, "Oh, the sky is falling. I give up. It's over. It's over." The next day, it's, I'm fine. I'm fine." So it is that bad. Today's rally was fairly predictable, but I will point out it's not that big of a rally. We're only up. From when we closed yesterday, we're up 0.37%. So this is a pretty anemic rally. Looking at the
Well,
stat
I
right
was
here.
I was more talking about just the 4 or 5 days before where we're rallying into
Oh,
this
right.
number. Yeah, and it seems to just be a common trend over the past couple of weeks.
Yeah, it's like they rally up into the number and then we give it all back on one go, and then they kind of take a little bit back, like you get a little bit of change back from your big loss. But yeah, it's so I guess what's bizarre to me is that you're right. It's like everyone's forgetting what we can all already see. It's like it's not like no one's going to the store. You go to the store, you see it, you see what the numbers are, you see how much things cost, and it's like, oh well, maybe next time it's going to be a lot better. No, it's not. I mean, it's not going to be a lot better. So the number basically was lower than I think the previous reading. I know the actual prices came down from one month to the next. That's true, but the problem is the number itself for year over year inflation came in higher than what people expected. So it came in at 8.3%.
I got it right
Yeah.
here, right? Yeah. Versus the estimated of 8. So it's like not
Yep.
it's still above 8%.
But this is important. This is important because that 0.3% difference, think about it like, so this is the way I look at it. Remember back during the post financial crisis years where the entire obsession of the financial elite was, how do we get more inflation? We got to get more inflation. We got to get inflation above to 2%. We got to get to 2%. Got to get to 2%. Right? They were obsessed about that forever. So if we came in at 1.4% and then next time it's 1.7, it's like, we did it. We've done something. It's a big deal. So it's a small change, but it means a lot. Just like unemployment, if you go from 5.3 to 5, that's a pretty big deal. That's a lot of people. So these numbers may not look like they're dramatically changed, but they actually mean a lot, and it has a very large impact on our way of life, the difference between 8 and 8.3. We also have to keep in mind that a lot of people are living on the razor's edge right now, okay, as far as their income versus their expenses. This is something where if you've got a family, you got kids, you've got mortgages, you got cars, you've got all the stuff that you pay for. Your lifestyle was built upon a certain level of price. Like there's always inflation, but not like this. So when you have this large of a jump in prices, it literally pushes people almost like, you could literally go from a middle class lifestyle to a low, not so middle class lifestyle just like that. So the same stuff is available. You just have to pay so much more for it that it's actually eating away at your income. So a lot of people I've noticed have said that. In fact, here's a statistic: 55%, 55% of workers say wages aren't keeping up with inflation. Now, this is, just to be clear, this has been noted for years that wages have not been keeping up with inflation. That's why people have to work more hours and two jobs and things like, and you have more debt and you have less savings. All those things are direct consequences of wages not keeping up with inflation, which has been the case since roughly the early 80s or so, maybe late 70s or so, somewhere in that neighborhood. In the 70s it started, but it really didn't kick into high gear until I think the early 80s, if I remember the stat correctly. Now you suddenly have a massive increase of inflation, and of course wages did go up, but not like this. So in short, a lot of people feel like they're not able to really connect the dots on their needs and their lifestyle. In Europe, of course, we're watching people literally losing out on their previous lifestyle, where you have to ration energy and go out and look for firewood to heat your home. And I mean, these are things that, let's be honest, like folks, those of you listening, let's think about this. If this were 5 years ago, and someone told you that in a few years you're going to be going out for firewood to heat your home because your natural gas bill is so high that you actually cannot afford it, and you are working a good job with a good income, and you've been doing that for years, but you're just going to have to go out and chop wood. Most of us say, come on, that's just like, some apocalyptic stuff. But here we are. We're there now. And it's going to happen for the US too. Like, a lot of us are ignoring that, but even I think it was either a Federal Reserve member, one of the officials in the government, not like a small fry person, but I forgot who said it. But I think it was Yellen actually who said it. She's now the director of the Treasury, but I think she actually said that come winter, the US is going to start to experience an energy crisis too. And she's basically pointed out. Now, Yellen has generally been pretty reserved in what she says. Like, Powell has been more like, hey, we got to do something now. Yellen's been more like, well, everything is fine and we're not in a recession yet. And President Biden's doing everything. She's been that person. Like the mother's patting her in the back and saying everything's fine. And now she's basically saying, oh, by the way, Junior, come winter, yeah, we're going to be having some problems. so, so to me, all of this stuff points to the same conclusion. I agree with the Fed member who said the market is not pricing in reality about the persistence of how interest rates are going to have to stay high. The Fed's already said what they got to do. So it doesn't matter what the politicians say. Like, I saw Elizabeth Warren, she was going on and on about the Fed. You can't raise interest rates, and it's going to push people into unemployment. And the Fed already said that's what they want. They said it. So I'm just like, did she not get the memo that they actually said that employment is too high, and we need to actually get more unemployment? They said it. Powell said whatever it takes. So to me, it's like, when I see this kind of political grandstanding, she's not the only one doing it, by the way, just not to pick on her, but she's one of the more outspoken people. But everyone seems to be doing the same thing. They're talking about this like, well, all we have to do is speak about it, and they're just gonna suddenly come up with this magical solution they've never come up with in 100 years. But suddenly now they're going to come up with this great solution that doesn't require us to raise interest rates, doesn't require any type of sacrifice, doesn't require any type of hardship. They're just going to, and it's going to be fixed. No, it's not. The Fed has a limited arsenal of things they can do, and that's by design. So therefore, interest rates are their primary weapon. And the reality is, after all these years of cheap money, what did anyone expect? I mean, at some point, you got to sober up. At some point, the party's over. And now it's time to get back to reality. And reality, the longer we dragged it out, the harsher it was going to get. And here we are.
Yeah, and that's probably why we have these drastic pullbacks when we get smacked with the reality of the news.
Right.
And I was even hearing some of the commentators yesterday saying 100-point basis move in the next meeting, which I mean, that is quite a significant change, and will only impact those industries that are already starting to feel it, like real estate, and some of the commodities. And these inflation numbers, this is while oil is still coming down, right? Like, I think we're down like 25% from the highs in June.
Mhm.
And who knows, like we may be reaching a floor there where oil prices are going to start to go up a little bit again going into the winter season, you know?
Well, this is a point that I have to emphasize. Reality is this: commodities prices aren't really going to be able to go but so low. And the reason why is because our supply chains and our resourcing is just not up to speed. Okay. So everyone can point the finger, but the reality is there was no serious investment into oil infrastructure. We've got political leaders literally jumping over each other to pull back and cut back on energy production and say, hey, we're going to build all these windmills, we're going to build these solar farms, and everything's going to be fine. Germany did that. Look where Germany is now. You know, and that's before the Russian invasion of Ukraine. Even before that happened, Germany was already in trouble because they finally realized, oh crap, it's not as easy as we thought. There's a lot of dreamers in politics in leadership, from my experience. Like they're people who just seem to have no real sense of how the world actually works. They talk about these grand ideas, and when you get down to, okay, so how are you going to do that? How are you going to accomplish that? Oh yeah, we're going to do, we're subsidize. There's a German I forgot what she was, an energy minister or something. Like she said, basically she said this: people are going to go out and complain on the streets that, hey, my energy bills are too high, and she's going to say, yes, I know that, and we're going to have social programs for that. Okay, so what is a social program going to do about missing energy? Like the energy's not there. You can't just sign a check and say, hey, we're going to write you this check that says you're going to get more energy. You're not, because it's not there. It doesn't matter how much money you come up with. You can write all the checks you want. If it's not there, it's not there. So that's the reality we live in, you and I and everybody else. Their reality is like, oh, well, we rewrite bills and we say stuff, and it poof, it suddenly happens. So I mean, we're basically seeing a crisis of leadership. We're actually seeing clearly that most of these people had no idea what they were doing except how to get into office and sound good and look good. And then when there's actually something that needs to be done, they're just blah, 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 talking, 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 and nothing's actually getting done. So I know I'm not alone when I say this. A lot of people I talk to, clients, friends, people I meet at random, they're frustrated. They're just like, what are these people doing? Like, don't they get it that you can't just will things into existence? You have to actually put in the work. But we're in a kick the can forward type of mentality, it seems like, in our leadership. And unfortunately, we can't blame them entirely because we're the people that put them in there in the first place, or at least some of them. And then you have the unelected officials that, well, that's a different story. So in short, um, I think commodities prices are going to stay elevated. They depress from where they were, but in practical terms, everything's costing more, and it's not like we're making more oil. I mean, we have, war causing energy supply to be taken off the market. You have different groups like the EU trying to penalize countries for buying energy products from Russia and everything. I mean, if you're trying to stop oil supply and you're saying, well, we're just doing it to punish Russia, okay, you're punishing everybody. You can't just take oil from one place in the world and say, oh, we got other supply. No, we don't. The US is not producing enough. OPEC says they're not in the position to really increase. In fact, they're going to decrease, right? So, in short, they'll make sure oil prices stay high. And as far as everything else, I think we're the scenario that I expected before is happening. We're getting stagflation. We're just getting massive stagflation, less economic output, higher prices, more stress, and that's where we are.
Yeah, and I think the Dow was down like 1,200 points yesterday. So once again,
Almost 1300.
it
Yeah,
once again, inflation is still here, guys. And so looking at the rest of the week on the calendar, we've got some PPI data, which probably won't be, or will probably be similar to the CPI data. We got some retail sales.
right.
And then I think we're going to be eyeing, what's happening with the Fed is going to be the next major report. So we'll keep an eye on that. But Mike, the reason that we have the show is no matter what happens in the
Right.
markets, right? We're here to take advantage of that. We're here to find opportunities. We're here to utilize the Madison trading software to help us make decisions. And in the next segment, we're going to run through a few examples that have come up in your scanners. And in the meantime, if anybody's watching or listening for the first time and you want to follow along with your own copy of Madison Trading Software, head on over to madisonTradingSoftware.com. I'm going to go ahead and add the link into the chat. You'll be prompted to create an account, but once you're in there, you'll get access to the software and you'll be able to follow along and do some of the analysis as Mike and the team does. And so once again, that's MadisonTradingSoftware.com. I think here at the top of the segment, Mike, I think we just want to run through some of the major indexes, starting with the SPYs.
Yes.
SPY.
So let's take a look. I'm on the wrong chart there. I'll go back to that one in a second because some of you are probably wondering, oh, what stock is that? Okay, so here is the SPY, the Spider SPDR ETF. All right, so basically, this is looking at it over a long period of time. Let's just zoom in to the last year. So here's the last year, and here's what it looks like. Now, I got a lot of stuff on the chart, so I'm going to take away some of the things here just so I can make it easier for us to view what's happening. Okay. So this is what we've seen over the last year. Now, it doesn't take a market wizard to realize that for the most part, the market's been going down. I'm going to zoom in to only show us up to, there we go. This is this year. Okay. So it's just been one long ride down, right? And here we are right now where we have a slight rebound off of this big drop. And that big drop that we see here, right? So we were up here, then the inflation data came out overnight, poof, we go down like a rock. We had a previous big down move here after a run up. So what's going on here? Like, why would they rally all the way into this number and then it all drops? I don't know. But all we know is the numbers didn't come out correctly. Now, a number of people ask me, hey, so is this where we should buy in? No. And I emphasize, no, do not buy in here. I can't say if the market's going to rebound or not back to where it just was. I don't know that. No one knows that. But what I'm saying is I can't give this a probability that, there's a good chance that it's going to bounce from here and go back up. There's a better chance that we might see some more downward movement. And once we get down to the bottom of this price channel here, right, that's where I'd be thinking about perhaps buying in. I emphasize perhaps. The channel represents how far the market is predicting that the stock is going to move. It's based on options data. Some of you are not familiar with options, but options always look into the future because their prices are based upon future expectations of how up or how down something will be. In this case, the SPY. So down here is exactly where the market has already predicted that the SPY is likely to go down to, at least at this time. And that will change as we go forwards in time, but at least we know that if we went down to here, that would be pretty far. Okay. So in short, I know that somewhere between 370 and 380 is where the market has already expected that we could go down to that far. Okay. If we're down to there, I would feel confident looking for a short term buy because usually you get these nice rebound moves when you get to the bottom. Okay. Now, it works better if the market's going flat. If it's actually going down, I would be more cautious about it. So if we're in a projected downtrend, or sorry, not projected, a prolonged downtrend, we're already in a downtrend and we get to the bottom of this range, we may bounce back eventually, but I wouldn't be too keen to buy right away. I'll wait for things to really come back up. This is a strategy that we use a lot to find buying opportunities. It's actually very effective. So if the market's flat or going slightly up, it works even better. If you come down to the bottom and the market's flat or going slightly up, you'll usually get a very clear, quick rebound. So I would only be interested in trying it there. And if it doesn't keep going, I would get out pretty quickly. So I can't call the tops or bottoms. The market basically does the estimation for that. Our software just knows to read the numbers, read the data, and then use that to anticipate. So that's what we got for the SPY. Right now, we're in the middle of nowhere. We're not really towards either side, which is where you're going to get the most risk. Now, if you're an options trader, and I mostly trade options, I trade stocks too. Usually, I do them in combination. So I would say that this is probably not a bad place to look for certain types of options trades. But if we are looking to get the most reliable result, I would say wait for us to get to the lower or the upper edge. And that brings me to the QQQ. Okay, so let's look at that. Now, so the Nasdaq is the QQQ, SPY is the S&P. They're going to be slightly different. Now, what I should emphasize is that both the Nasdaq and the S&P, each of them are actually hovering right at the bottom of the range they've recently traded in as far as price. So remember, I've got two things on my chart. One is the price channel that's projecting a future range, and the other one is the price channel that actually defines the existing range. So this yellow channel tells me what's already happened. We covered this last week when I discussed how this works. So if you didn't see that episode, be sure to check out last week's episode where I explain how to use this. So we're hovering right at the bottom of this range. And what I've mentioned before, as I'll mention again, is that when we're hovering down here, we're at a critical point. We need to see if the market wants to go any farther down or not. So as of right now, we're just kind of teetering on the edge. So if it breaks out of this range, we may get a short-term move down. Not something that I would personally trade, but I would recommend that if you're a buyer, you start to see this breaking down below the range we've been in recently. My advice would be that you should be looking to exit or at least to reduce your position. All right, so going back to the QQQ, and let me just get rid of the channels for a second. Okay, so I don't have to keep doing this. So we're in a similar boat, similar situation as we are in the spider. We're in the middle of nowhere. We had a drop down. This down here, just below 280, is where the market projects the low of the potential range at the moment. And up here, just above 320, is where it projects the potential high at the moment. Again, it doesn't mean that that's what it's saying will happen. It's just saying that if we make a really big move up or down, that's about as far up as we would go if we really have an aggressive move up, and this is as far down if we had a really aggressive move down. So right now, even though we had a sharp sell off, it actually could be a lot worse. So right now we're just kind of sitting there. Look at this in comparison over here back in June. If you see the trajectory of how quickly things went down, that's a really, really, really quick move down from July 9th to July 13th. But as we got to the bottom of the projected range, we stuck around for a bit and then we finally reversed off. And by the way, guys, these aren't Bollinger Bands. People always ask me, are these Bollinger Bands? We discussed this, I believe, 2 episodes ago. Maybe it was more than that, but it might have been more than 2 episodes ago. But these ranges are projections into the future. They're not based on what the stock has already done. They're based on what the market is projecting will happen to the stock in the future. So that's why it's so valuable. So you know where these points of interest are before we get there. All right. Now, looking at the Dow, the DIA, I'm assuming it's going to look the same as the SPY, and sure enough, it does. Looks a little more flat, but again, the same picture that we're hovering towards the edge. We haven't really gone down very sharply, so I wouldn't see this as a place where I really want to buy. If you're a day trader, you can catch some upward momentum after big moves down. Usually the market trades reflexively. These indexes, they go down one day. If it's a big move down one day, usually the next day you get a bounce, but not always. Remember, we were looking back at June where we took a nosedive right here and it did not bounce back. It's just 3 days in a row of straightforward selling. So if anyone tells you it just has to go up the next day, they're wrong. It doesn't. It can keep going down for sure. So if you see that there's a weakness in sellers, there are not too many of them there, and the market's not doing anything like this, and it starts to rebound, then perhaps you can get a day trade in for that. But if you're looking to hold, I would say wait. And then lastly, the Russell IWM, Ms. Mary. This one looks a little more flat, so we're not seeing as strong of an upward trajectory there. So if it bottoms out down here, it'll probably be more effective for the Russell. But as you can see, the Russell looks a little better than the SPY and the Dow because the swing down that we see here didn't come anywhere close to these levels we saw recently. So looks a little better. Looks like it's going to hold up a little better than the others. So I would say on the scale, the Russell looks like it's the strongest contender for a good upward move, whereas the SPY, the Dow, and the Nasdaq look about the same. They all look like they're teetering on the brink of falling. So in short, that's where we're at right now. And if I look at the overall market overview, which I'll just jump to here really quick, um, as far as the 52-week highs and lows graphic over here, we clearly see that most stocks are trading near 52-week lows. So that means that there is the potential that we could see some upside, but remember, there's a lot of negatives that are still out there, fundamentally, which means that even though technically, yeah, you want to buy when things are low, you also want to understand that if it looks like things are going to go even lower, there's no point in buying now and just wait. So I don't think we've seen bottom. I think we're just teetering on the brink of going lower, and we would need something very positive to come up that would actually move the market up. I don't know what that will be because everything I've seen so far is fairly negative. So perhaps the numbers that come up this week, maybe retail sales are going to look good. But I think if retail sales are up, that's more inflation pressure because apparently that's what they're claiming is driving inflation and consumer spending. Consumer sentiment, that could be a big number. But none of these things will probably be enough to turn the tide. The only people who can really change things are the Fed, and of course, we're waiting to see what they do with interest rates this month. So if they come out and say, "Hey, we think things are better than we thought, and we're only going to raise 50 basis points," that would be a very strong positive for the market. But if they say, "No, we need to keep going with this plan. We're going to raise at least 75 basis points, and we probably can do more," if they say something like that, which is probably what's going to happen, then that adds more conviction that the market should be trading lower rather than higher.
And that channel chart that you were just going over, that could be applied to every stock. That's correct. Yeah.
Yes, yes, this can be applied. Um, this one can only be applied to any stocks that or ETFs that have options. If they don't have options, this won't work because it's using options information to help produce these projections. So if it's a penny stock or something like that, won't really work too well. But if you're looking at major ETFs like the SPY, the Dow, it's going to work exceptionally well. So therefore,
Wonderful.
that's where we want to use it.
So we'll go ahead and add that video of you describing and going into detail on how to use that tool. We'll add it to the chat. You could also find it on the YouTube channel.
Hmm.
One of the other features that is really, that really makes Madison Trading Software unique is the scanners and the ability to program it to find names that are in the market that are moving, that are catching wind. And I think one of the next names is one that may have come up on your recent scans, and unfortunately I don't know how to say the name of the company because I've never heard of it, but it's ticker symbol LNG, and I'm gonna take a stab. Chenier, is that what you said earlier?
I don't know exactly how to pronounce it either. It sounds French, so who knows? But yeah, I think it's pronounced Chenier, or Chenier. But either way, the symbol actually tells you what it is. LNG, liquefied natural gas. That's what they do. So if I jump to my dashboard, here's a brief synopsis of what they do. So Cheniere Energy owns and operates the Sabine Pass liquefied natural gas terminal via its stake in Cheniere Partners. It also owns the under development Corpus Christi liquid natural gas terminals, as well as Cheniere Marketing, which markets LNG using Cheniere's gas volumes. So, in short, they're in the natural gas business for liquefied natural gas with operations in looks like two. I think Sabine Pass. I believe that's foreign. I have to look it up, but I believe that's two places. I know Corpus Christi is here. That's in Texas, where my sister interestingly enough, was born. So, I know where that is. Now, in short, why is this a big deal, guys? Firstly, Europe needs natural gas. Okay. I mean, Sip, you were just telling me about your father being in Europe and telling you how bad things are over there. He was in Poland, I'm guessing, or yeah.
Yep, East Block.
Yep. So basically, and everyone I know who's in Europe is telling me the same thing. Things are bad. They're bad. The energy crisis is real. It's serious, and it's not going away. So liquefied natural gas is one way that Europe has been basically helping itself to get more natural gas in the absence of Russian gas. Um, long time ago, unfortunately, I don't think we had a lot of time to talk about it on the podcast, since this was back before I think we were doing this podcast. But um, when this whole crisis broke out with Russia and Ukraine, one of the things that I mentioned early on was that Europe is heavily dependent on Russian energy. It's not like they're fully, almost fully dependent. And I know that it's not that easy to replace energy infrastructure and get new supply. I mean, you have to think, you have to build pipelines and everything. So it's not that easy. It takes a lot of time. So when the European leadership was making it seem like they had some easy solutions to replace natural gas, I knew that was all nonsense. It's all, posturing. It's all to make people think that you have control of a situation that you don't. And of course, now we see the reality that they don't. All the places they said they're going to get more from, they haven't really. The United States is in a position where we can send a lot of natural gas because we've got tons of it. I mean, back in the day, we were burning the excess natural gas, from oil production because, like, yeah, we don't need it. I mean, that's how much we've got. We're just swimming in this stuff. So, and there are other places in the world that are similar, but the point is, you got to be able to get it somewhere. So we can't just overnight build a pipeline from Texas or Oklahoma all the way until Europe. I mean, that would take forever. The engineering alone would be unbelievably costly, and you take probably 5, 6, 7, 10 years to do something like that. Um, so even if it was on a fast track, it would take years. So in short, the only way to do it is liquefy natural gas. But here's the problem: liquefied natural gas, you have to have terminals to put it into the container ships that are designed for it, and we don't have enough terminals. So, like, think of it like EV charging stations. They're becoming more popular now, so you see them everywhere. But remember, like 10 years ago, you have to go around to find one, right? So it's not that the technology's not there. We have it. We had it then. It was just that there wasn't enough infrastructure to facilitate. So just like as more people drive EVs, if that literally becomes the new thing, which it might, then we'll need to have many more stations that can, charging stations. So that's just reality. Just like gas stations, and probably in the very early days of cars, you didn't have a lot of gas stations because most people were riding horses. But eventually, you get the infrastructure, you get the buildup as it becomes a marketplace. So in short, liquefied natural gas is a marketplace. China buys a lot of it, but you can't just up the shipments and the transport of this stuff that quickly. You have to build terminals, and they take apparently a lot of time, and they're very complex. So Europe is in no position to suddenly build a bunch of natural gas terminals. It'll take them a while. So that means that the supply that's available now is more limited than it was before, which is pushing prices up. And that's why, if you're in the United States, you probably noticed that your natural gas bill went up, because I noticed mine did. Mine actually doubled at first. Now it's quadrupled. The last I just saw the bill they're sending me, and it's literally double what it was after the last doubling. Now, I don't know if that's because that's just a one-time thing, or I don't know, but this is something that I saw coming. I was figuring that would come out, that would happen. So I actually made a move to a different residence, basically to to jump ahead of this. Like, I realized this is going to be a serious cost. Now, I'm being serious. Like, that was actually one of the major things I thought about. I was like, yeah, I need to get to another place because the place I'm at now, it's not efficient enough, with all this natural gas I'm using. So let me go somewhere where it's more efficient. Basically, move into a high rise, which is what I decided to do. So a lot of people may not be able to do that as quickly as I did. And I understand you may have a house and you're used to paying a certain bill and now it's quadrupling. So liquefied natural gas is a big deal. So Cheniere makes liquefied natural gas, or sorry, they are in the business of transporting and terminals and things like that. This is what it's looked like since the pandemic. So you had your downward move here, and then ever since then, it's been on the rise. I want you to notice how big of a rise this is. Went from about $30 to now we're at 176. 2 years later, just over 2 years later. So that's a huge, massive gain. And this stock was on the radar the entire time. So this is not something new. Anyone who's been a member of our services for a while, you've seen me point this out over and over and over and over again. And I explain why this is a logical thing to happen, that natural gas prices were extraordinarily low in 2020. And just like all energy prices, they just plummeted. They were already coming down before then. But the picture was pretty clear that demand was going to go up at some point. And if you have these really low prices that, in my opinion, were artificially low because there was just a lot of factors that influenced that, it was only a matter of time before prices went up. So these guys are making a lot more money. They've got a lot more shipments. They actually said, let me just quote them here. They said that they project, where they're doing, first, they're doing buybacks. They're doing energy. I'm sorry, stock buybacks, which means that they got so much extra money that they're buying back their own shares to boost the share price. That's a very clever tactic to increase your price per share. They're just making so much money that they can do that, and then they boosted their earnings forecast. So they're basically saying that they're expecting their profitability. They said they're going to raise their annual dividend by 20%. They said they expect to have more than $20 billion of available cash for payouts and investments through 2026. $20 billion. Um, I mean, their cash, their distributable cash flow forecast between 8.1 to 8.6 billion, up from 6.9 to 7.4. They're doing a $4 billion buyback. They expect that their earnings before interest, taxes, dividends, etc., to be 11 billion to 11.5. That's compared to 9.8 to 10.3. I mean, everything they're saying is good. And and this has been the case for a while. So they've consistently been doing well simply because they're just raking in money. And with the current situation, and I have to emphasize, guys, the situation in Europe is not going to resolve quickly. It can't. It's not possible. I mean, even if the conflict stopped right now, you would still have hangover aspects of that going for probably years. So at this point, this company is in a very good position, and so will other companies that are similar. So according to the charts, let's just analyze where we're at right now. Currently, we're at a breakout point. Now, this is again, there's that price channel, that shaded area in the background. This is very important stuff, guys. Very important stuff. This is basically telling me that we're at an extreme right now, at this exact moment. And I don't think the news is good enough that this will keep going. It may go up another day, but shortly after this, probably within a few days, this is most likely going to do exactly what it did over here. Just get to the top and then start to come back down. I don't know if it's going to come back down to the middle, but just expect it not to keep pushing beyond the envelope. It may keep pushing right on the edge, so it can gradually go up, but it won't likely go up at this pace, which means you probably will have a chance to get into this on a pullback, which is what I'm going to look for. Now, I've been in and out of this stock many times for the room, sorry, for our members. So this is not a nothing that we didn't know before. And here, by the way, is that entry trigger that I mentioned, where you've got an uptrend, the line's going up, you pull back to the bottom edge, and then you turn around and go up. That's why I like that, because as long as that happens, there's a very good chance there's going to be follow through. You don't know how far it's going to go, but you do know you're more likely to have a lot more upside room than downside. So therefore it works. So LNG looks good. It's been looking good for a long time. I don't really see much reason to expect them to lose any momentum, but just expect the stock to pull back first and then go forwards later.
Yeah, I was just taking a look at their website, and like you said, they got a lot of things going for them with this liquefied natural gas. It's going to be, huge, and so keeping an eye on that range, seeing if there's a pullback, and finding some opportunities to get in. Otherwise, a lot of the Madison check marks are being uh, you know taken off the board. So that's
Yep.
good to see. Moving on to our next name, it's one that's kind of been in the news, partially because one, there's a lot of crime that happens recently at these places, and so we're talking about Starbucks, the
Yep.
the Seattle coffee manufacturing darling retail. I mean, what's one of the weirdest things about Starbucks is when you see two of them on the same block. To me, that's always like blown my mind.
Yeah, it's true. It is. Yeah, it's true. They are that popular. Sometimes where it's like you go one block and see. Yeah, I've seen that
and
too.
and in Chicago, I think within the last year or two, they made that giant location downtown, like one of the biggest in the world.
Yep.
Um, but in the news, they are closing down a lot of the trouble area locations, and I think they're doing a lot of renovations. What are you seeing from your perspective, and why are we taking a look at Starbucks today?
Okay. Well, one very good reason, it's all green. I mean,
Wow,
just this thing is green across the board. Fundamentally, valuation, insider, institutional, and technical, all green. So it has to come up on the radar for that reason. Also, this is not a stock that we. This is not the first time I point this out. Starbucks. We actually had a position in Starbucks that we put out for our alerts over the last. It was like July. I think it was like late June to sometime in late July. So there was a nice run there, and then that was it for a while, and then now we got our pullback, which was what I was expecting, and now it's starting to run again. So Starbucks also, just like Cheniere LNG, it's trading right at the top, right? So I know a pullback is likely to occur. It is always possible you could just keep trading right at the edge and just gradually go up right along the line. But that's not usually the way it happens. Usually, what happens is you get to the top, you trade up there for a bit, and then things start to come down later. So that's what I'm expecting. Also, Starbucks is not like a stock. This is never going to be a meme stock because it doesn't appeal to the ethos of a meme stock. It's too popular. It's
corporate.
too Yeah, it's too corporate, right? So guys are just not going to be like, oh man, we're going to be apes for for Starbucks. I mean, they probably hate Starbucks. They probably. I think a lot of guys on Reddit would want to short sell Starbucks just to destroy it. So just saying, I don't have anything against Starbucks. I'm just saying that's the mentality. So, what Starbucks has done is they're reorganizing their company. They're actually improving, like you said, they're closing down trouble stores, which makes sense. Why keep them open if they're actually a drag on you than a benefit? So that actually increases their. Well, it doesn't actually decrease their revenue in the sense that yes, they get less money coming in, but you have less problems that lose you money. So therefore, getting rid of it is actually a good thing. So it's kind of like laying off a troubled employee, I guess, is the best way of saying it. They're projecting that profits will grow between 15 to 20% per share over the next 3 years, a significant increase from previous guidance based on spending plans of 2.5 to $3 billion over the same period. So what they're basically saying is they're projecting profit growth from tech, stores, and worker spending. A few things, and they're probably going to be right. I have to say, Starbucks is an extremely resilient company. There's lots of haters on Starbucks. I'm not really a Starbucks person. You'll almost never see me there. But at the same time, I recognize their brand. Their brand is a powerful brand. It's very well established, and there are a lot of people who are loyal to Starbucks. So if you've got that combination, it's hard to knock that company off. So despite all the things people may say about it, their brand has built itself very well. So I do think they have more upside. So at this point, let's look at what the fundamentals are saying. Currently, the projected median target is $97. The top is 122. The lowest is 84. So on this metric from analyst targets, we don't really have much going there, but analysts just were recently upgrading their targets. So this metric is going to update within the next day or two to reflect all the slower, the flurry of upgrades. So eventually, I think the mean projected price is going to go up. So I wouldn't worry about that right now, since we got a lot of upgrades that just came out. Projections into 2023 show potential profit growth. But remember, they just up their estimates themselves. So I think analysts are likely to follow suit. Um, I mean, the other metrics, growth wise, not much there, which is not surprising. They're kind of like McDonald's. Once you get to a certain point, you can't really grow anymore. As far as cash flow, profitability, etc., they're all looking fairly good. So I'm not really seeing much to worry about there. Valuation wise, PE and forward PE are both in a good range. So that means the stock is not actually expensive compared to what it's doing revenue earnings wise right now. Price to cash flow, price to sales, all these numbers look fairly good. Price to book value doesn't look good, but that's only one metric out of several. So I would say Starbucks looks fairly solid, as a potential. Now, the projected future price, according to the software, is $126 a share if the growth rate stays about the same. Remember, Starbucks just upped their guidance, which means that their growth rate would be larger than what it was the last 12 months. So if they're right, then this projection is probably true. So basically, if I read that for what it says, I've got about a $30 potential upside based on the current projection from the model from the software compared to a lowest analyst estimate, and that's before this guidance came out from Starbucks. This new guidance that they released, the lowest estimate was $84. So I got about $9 of downside, $30 of upside. I can deal with that. You know, I think that's reasonable. And as far as what institutions are doing, 6.34% increase in institutional ownership. They have 100 more buyers, 219 fewer sellers. That's pretty big. They're in no, their top tens are in 35, no change in the top tens. Starbucks is not likely to be in a top 10 list anyway because it's not a growth stock, as I mentioned. They're not going to make a whole lot more, open a whole lot more Starbucks. They're closing stores, so they're not going to be like a tech growth company. But as far as their revenue and their earnings, they look like they're going to go up. So I think that's why investors are coming back in. Also noticed that the interim CEO Howard Schultz has actually bought a lot of shares. So yeah, looks like he's pretty confident in what's going on. He bought these back in May, but still, that shows confidence. So in short, mostly this looks like a good deal. Looks like something that actually has some potential. Um, so I would say, yeah, this is worth getting into again. So we were recently in Starbucks looking at the technicals here. I don't think right this moment is the time to buy. I always look for a pullback first, and the pullback I'd be looking for is somewhere around $88 down to at the lowest around 82. So between 88 and 82 is where I'd be looking to buy. I will put that out as alert for sure in the broadcast that we do each day, so people can take advantage of that. And then, yeah. Other than that, I think that this one shows some good qualities, and definitely the score is one of the highest I've seen ever. I mean, we're at 76 on our score here for the fundamental for the four box system. That's very high. That's not normal. So I think most likely we'll get a pullback on the technical part of the score, but everything else is going to be solid.
Yeah, and given your analysis and that low end analyst, I like 84 as a little pullback area
Hmm.
myself. So this is a great example of a lot of the things coming together, and we'll see if they can, withstand these inflationary pressures as we go into the holiday season. I don't see demand really falling. People love their coffee, and they make it very convenient for you to be able to grab it from them. They have a wonderful app, and I imagine their margins are phenomenal. So great pickup, great identifying name. Starbucks. We'll go ahead and add that to the list. We did have one more topic we were going to cover here, but I don't think we're going to have enough time, so we'll go ahead and save that for next week.
No problem.
Another trend study. But what we want to do one last time is go ahead and invite everybody to take a look at the Madison Trading software for themselves. If you head on over to MadisonTradingSoftware.com, sign up for the demo. We'll get you instructions on how you yourself can get access to this wonderful software. You could always head on over to the YouTube channel, watch some of the other videos to really learn how to utilize all the features. If you have any questions, you could always reach out to the staff, and they're there to help. I know Mike does a few more one-on-one, more group type webinars throughout the week. So if you just reach out and figure out the days and times for those, he will get you access to that. With that being said, Mike, any final words, anything we should be keeping an eye on midweek, going into the end of the week, going into, mid-September?
The middle of the month, I would watch on Friday consumer sentiment. I do want to see if people really feel positive about the economy or not. I think the expectation of mine is that they're going to be less confident, but if they come in more confident, that could be a good sign. But I would watch that as the major number, and also, of course, we need to look for the Fed's rate decision, which will be, let's see, that will be, what day is that? Funds rate, that will be Wednesday of next week. That's the big one. That's the big one. So, of course, folks will be talking about that before it happens. So make sure you tune in for the next podcast so we can give you our synopsis of what we're expecting. Also, a lot of monetary policy decisions are coming out next week. Bank of Japan looks like it's going to be doing that. Australia looks like Britain as well. So a lot of looks like a lot of financial stuff is coming out for the world next week. So next week should be fairly interesting on the financials. So we'll see what happens.
All right. We'll definitely keep an eye on that. So if you've enjoyed the broadcast, the stream, feel free to hit that like, hit that follow, hit that subscribe button, and we'll try and get you quality content week in and week out. Mike, thank you for your time. Everybody, thank you for tuning in. We will catch you guys next week.
Take care, folks.